Hello everyone, Corey here with the Cyclical Investors Club YouTube channel. And this video is going to be a topical video about what I consider to be Warren Buffett's most important concept. Now, I've learned probably as much from Warren Buffett and reading about him, reading his letters, reading his biography, listening to his interviews, watching the shareholder meeting Q&As. I've learned as much from him as any other investor, but one of his early concepts that doesn't really get talked about much or written about, I think is probably his most important one, because a lot of everything else he does derives from it, okay? And that's the concept of equity bonds, or treating stocks and equities like they were a bond. It's basically what Buffett does is he says, okay, you have a bond, okay? Let's say you have a 10-year or 20-year or 30-year government bond. It has a yield when you buy it, okay? And that's what you're going to get in return, so long as the person that sells you the bond has the money to pay you back in the end, okay? So as long as the quality's there, you know you're going to get that sort of yield from the bond, all right? So if we can apply that very same concept to stocks, even though most people don't think of it that way. And the important part about this is, if you can do a handful of things well when it comes to picking stocks and having a strategy that incorporates this, you can basically get rid of almost all your long-term bond portion of your portfolio. Because if you can do the stock portion well, if you can do the equity yield well, then, especially if you can do it over time and build up enough money throughout the course of your lifetime, you really don't have to have any long-term bonds at all. One way to think about this is, if you take Berkshire Hathaway, it's usually compared to the S&P 500 in terms of performance. And Berkshire's returned on average like 20% a year for like 50 years, okay? So it's completely blown away the S&P 500 over the long term. Over the last 10 years, not so much. But the important thing to keep in mind is, you really don't, Warren Buffett doesn't own a bunch of long-term bonds. He doesn't have a 60-40 portfolio. He basically just owns Berkshire and then a small account for himself, relatively small, compared to Berkshire. So basically, all of his retirement, all of his wealth is tied up into Berkshire Hathaway, which is equity. And I think individual investors can basically do that too, provided that the portfolio can grow enough before they retire. Okay, so we'll get into some of these kind of very important things to consider. Okay, I'm going to have a quick disclaimer here, and then we're going to come back and I'm going to get into how I go about calculating the yield for the equity bond type approach. Okay, and I'll cover some of the nuances that are definitely really important before a person starts trying to take this approach and phase out their bond portfolio. Hello everyone, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and this is a channel where I share my investing process and strategies using examples of stocks that comprise the S&P 500 index. These videos are for educational purposes only and are not personal investing advice. If you would like to receive analysis on stocks that are not part of the S&P 500 index, as well as receive additional in-depth portfolio strategies, consider joining the Cyclical Investors Club premium service. It has produced market-beating ideas and strategies, costs less than $30 per month, and it helps support the investor education and research that I share with the public. With that, okay, if you watch any of the videos that I have on here, or you read any of my articles on individual stocks that are not really cyclical, so they're not super cyclical, and they have relatively steady earnings, you'll see that basically my approach is to take, I look 10 years forward, okay, and I estimate a mean reversion. So that portion of the estimate is basically if the market were to change its mind about this and just treat it like it kind of has averaged the previous cycle, what would that do to the stock price and returns, okay? In order to think about the equity, if you think about it as an equity bond, that doesn't really matter, okay? So one of the reasons I keep these calculations separate is so I can separate them in my mind and when I'm thinking about buying them and how the returns are likely to come back to me over time. So we take that mean reversion and just set it off to the side, okay? The second part of my calculation is what I call the business CAGR, okay? So that's how much earnings the business, how much money the business is likely to earn over 10 years. And I translate that into a CAGR just using like a CAGR calculator. So basically what I do is I say, okay, if I bought this whole business and I just kept all the earnings for myself for 10 years and just hoarded them, what sort of CAGR would that be if I added it to the money that I already paid for the stock, okay? So how much money basically would I make for the stock and what does that work out to on an annual compound basis? And that business CAGR is basically the same as a yield on a bond, all right? That's the way to think about it. So I usually don't buy stocks unless that's over, the business CAGR is over 8%. I like to have it over 9%. Back in the day before the market was really expensive, 12% would be a better target to aim for probably. And that is basically, you can think of it as the stock equivalent yield compared to the bond. So if I went out and, the stocks I've been buying lately have had like 8% business CAGRs, okay? The 10-year treasury has about a 1% yield. So I'm getting 7% more if my estimates are correct or close to being correct, 7% more per year or 700 basis points per year on the equity. Now, the difference is that the business, after it gets those earnings, it has a choice of how it allocates that capital after it gets it. So we've seen a lot of investors, especially leading up to the pandemic, were looking for yield. They're looking for high dividends, okay? And if a business is giving all their earnings or a lot of their earnings back to investors, then the dividend yield should be pretty high. So one of the reasons I look, if I have a really slow growing company, I look for higher dividend yield before I buy it, because I want that. If they can't find a place to put that money, then I want it coming back to me as an investor, okay? But the rest of the time, the company can basically do three or four things. It can reinvest that money in its own business, it can pay down debt, it can buy back stock, and it can pay a dividend. All right? So you basically have these four choices of what to do with the earnings that they come in. And so usually when I buy a stock, or almost always when I buy one of these stocks, I would just look and see how they're investing this extra money that they're making every year. Are they giving it back to me? Are they buying back stock? Are they making acquisitions? Are they paying down debt? Are they just holding it in cash? They can just hold it too. So that's a possibility. And I just see whether it makes sense or not and see how much it is. So how much are they giving back and so forth. That all counts as the equity yield, but you have to make judgments as an investor on whether what they're doing makes sense. If it's a really slow growing company, it doesn't make sense to me for them to be investing a bunch of money back into their business. I mean, they might have to in order to produce the returns that they are. So there's just a lot of these things that you can watch out for when you get into it to see what sort of capital allocation they have, whether it makes sense, whether you should really count all of that 8% as a yield that you're likely to get as an investor one way or another, okay? So that's a lot of the judgment that goes into when you're going to buy a stock using this approach. And that's where a lot of the effort goes in, but it's really just like a bond investor would do, trying to determine whether the business can actually pay back the money for the bond, okay? So you're really thinking, okay, if it's a fast-growing company and they're reinvesting their money back into the same company, then that earnings growth over time will eventually come back to the investor, or the market will recognize it and you can sell the stock at a much higher price because the market sees that the business has grown over time, right? So it's a little more complicated, but if you can buy good quality stocks at good prices, meaning the price corresponds directly to what the yield on the earnings are, okay? So a lower price means you're getting a higher yield as an investor. So let's just move on to some of the important considerations here. One is you have to have confidence in your stock picking, okay? Whatever process you're using, it needs to comport with reality, but I mean, you really need to have confidence in it, that because the stock prices can vary a lot. You can buy a good quality company and it can fall 50%, and the company maybe hasn't changed at all, and you may have been right about the quality of the company. So you can't judge it just on what the market does, especially over the short term. So that's one thing. You have to be able to judge the quality of the company over the long term, which is, I usually say, like 10 years, okay? If you're going to not own any bonds in your portfolio, any long-term bonds, you have to have, or you should have, emergency cash available. Now, depending on what part of your life you're in, the amount of emergency cash is going to vary, okay? So my wife and I both work. We probably have 6 months to a year of emergency cash that we can go and access and pay bills if something happens or whatever. If you're retired, then, or you only have one income, I mean, there's a lot of different factors. You can talk to your financial advisor about it. But you need to have enough cash if you're withdrawing money from your portfolio and in retirement, so that if the market sells off 50%, you aren't selling your stocks at a trough, okay? That's the big risk of not having any bonds. So depending on how much you spend relative to how much you've saved throughout your entire life, that will determine how much cash you have. Now, if you look at Buffett for his widow, his future widow, he said he directed his will and estate to have 90% S&P 500 and 10% cash. Well, he has billions and billions of dollars, okay? So his wife can live off 10% of his money just like she's probably living right now, all right? For other investors, that might need to be more, but I think of that as emergency cash, okay? Even in retirement. So take your pension or Social Security or whatever, and that's really kind of your bond portion of your portfolio. You have your cash, which is what you would need to not sell your stocks during an extended sell-off. You know, minimum 1 year, I would say average 3 years, and if you're more conservative, it will be longer, okay? So that's how much cash you need to have, and it really is emergency cash. And I feel like it should be in short-term type stuff, money market, savings account, CD, whatever, stuff you can access soon, not long-term bonds. So if you have your emergency cash, if you know how to pick stocks reasonably well for the long term, okay, at decent prices so that they'll give you a good yield, you can't panic at the bottom either. You have to understand what you're doing, and you have to have confidence in it. When everybody's freaking out, when the market drops 65%, which could absolutely happen in the next few years, it's totally possible. You have to have confidence that, okay, this is I'm not going to sell. I'm going to use my if you're retired, and this is when I'm going to use my reserve cash. And I picked quality stocks and I spread my bets around. I have an unconcentrated portfolio, and some of them might have things that happen because things are going poorly, but most of them will eventually come out over the long term and I'll be okay. You have to have that mindset. If you're going to panic, it's just not going to work. And most people will panic because most people, one, they don't know really what they're doing, okay? A lot of time, these events where you lose a lot of money don't come around often, and especially they don't come often when you're in retirement. So it's hard to plan for them mentally. It's hard to have gone through it at the same stage of your life that you would go through it for the first time if you just retired or something like that, and you expected your portfolio to really be able to provide a good lifestyle for you. So in order to do that, you have to kind of have some experience under your belt and so forth. And most people can't do that. So that's why when you go into an advisor or over the last however many years, they say 40% bonds or whatever, or sometimes more, 50%. But the returns on your bonds are not going to be good going forward. It's just basically a fact at this point. And if you haven't saved enough for retirement, there's not an easy, quick fix to do it. If somebody comes out trying to sell you like high yield or covered calls or whatever, look, it's not that it can't work, but you have to realize that you're taking on extra risk. There's just no free lunch. If you don't save enough, what you have when you retire is what you have, and nothing can really fix that then. You have to still live below your means and do all the things that you kind of need to do. There's just not really any other way around it, except getting lucky in the stock market. But at that point, it's really like going to a casino. Your odds might be a little better in the market, but you just have to realize that it's just not a free lunch. It's not. So if you're a little short on money for retirement, then it might make sense to have more bonds in there, because the stakes are going to be really high. It's really going to affect your life if your portfolio loses a lot of money and you have to draw money out of it, okay? But if you're still in the building phase, if you're not really close to retirement, chasing yield and having a bunch of long-term bonds in your portfolio just doesn't make any sense to me. And that's where the Warren Buffett approach really comes in handy, because it totally crushes a 60-40 portfolio over the long term. Even if you didn't get Warren Buffett's 20% or Berkshire Hathaway's 20% a year, if you got 15%, you're just doing great. And you actually, if you know what you're doing and you can pick quality stocks, you're going to do well during the downturns because you're going to be buying, okay? So it's an easy concept in some ways to understand, the equity bond concept. It's easy for me to carry out because over the years I've trained myself and I understand it, so I don't panic when the market goes down. But it's a hard approach to just immediately switch to if you don't have a lot of experience with downturn, especially with downturns, and if you don't have a lot of confidence in the individual stocks that you're picking, because like I said, the prices can fall a lot. It doesn't mean the business necessarily has been damaged. So you have to be able to recognize that. Okay, so you can do more research on this. Just Google it. There are people that have written articles about it, probably much clearer than I've articulated here. But what it leads to is a more conservative equity portfolio, a higher quality equity portfolio, okay? I avoid overpriced stocks, and I avoid IPOs. I avoid lots and lots of stocks just because they don't meet my quality standards, or I don't know enough to have the confidence to invest in them. And so that leads sometimes to lagging results, especially when the market is going really fast, especially compared to some high growth NASDAQ type portfolio. But when you take into the consideration that I don't have any long-term bonds, it's not nearly as conservative as that initially looks, okay? So you have to be really careful in the stocks that you pick when you don't have a bond cushion, and that's what I try to do. Now, it's just kind of a quirk of the stock market that this actually leads to higher stock returns usually on average. And that part's a little harder to like explain, but basically if you avoid mistakes, you do well, and if you sell stocks when they're expensive, you do well, and if you buy stocks when they're a little undervalued, as long as they're high quality, you do well. And when you add all those together, there's sort of a Lollapalooza effect where you can pretty consistently get very good returns. And then if you don't have the bond portfolio weighting things down, then you get really great returns. You just have to take those other important things into consideration. Emergency cash, picking good stocks, not panicking, and not paying too much for the businesses that you buy. All right, that's my topical discussion for today. Like I said, Google it, Warren Buffett, equity bond. Maybe you'll be able to find it in some of his letters. I know there's a couple really good articles on the net about it. And just think about it in the back of your mind, because bond returns going forward are going to probably be negative in real terms once we get a little bit of inflation. So I think now more than ever, this strategy is attractive for investors willing to put the time, the work, the thought, the practice in, and to try to get some good returns over the next 10 or 20 years. All right, that's all. I'll hit the subscribe button if you enjoyed the video, and I'll see you guys later.